Good afternoon, ladies and gentlemen. You're welcome to this segment. I am very pleased to be at this 6th International Conference of the Interdisciplinary Social Sciences. My name is Auwalu Haruna, and I am from the Department of Accounting of Ahmadu, Bello University, Zaria, Nigeria. I am presenting a paper titled In-Market Consolidation Model and Cost of Financial Intermediation in the Nigerian Banking System. The work, in a typical manner, is organized first with the introduction, the literature review, methodology and modeling framework. We look at the empirical results, then we hit the level of conclusions and recommendations. I hope to get a substantial contribution on this work, because it's a work that I am, it's an extract from a PhD thesis that I am currently working on. We know generally, by way of introduction, the process of liberalization and globalization has really brought about fundamental changes, not only in the banking system but in the financial system within the 20th century. In response, Nigeria began the process of its own four-phase openness with chance of reforms by 1986 through to this period. It started with the interest rate liberalization, whereby a market is now allowed to determine interest rates and exchange rate, which hitherto were set by a central bank in a discrete and static manner, which did not allow the system to work well and respond efficiently. Also, importantly, after the reform, by about 2004, the system witnessed boom and bust very clearly. According to Hesse, it kind of indicated almost financial disintermediation with fragmented systems that necessitated, given the expectations of improved productivity through strengthened system, with that fragmentation, it became necessary, to see that the system has not significantly, benefited from the openness. Now, more so, studies of developed markets had indicated that not all banks have benefited from such consolidation moves in terms of increasing productivity. When you look at the theoretical analysis and empirical predictions on the relationship between bank consolidation and competition, and bank consolidation and financial crisis, there are various symmetric propositions. One is the proposition that concentration leads to efficiency gains. Clear, this one's claim. The other group of studies, posit missing link in explaining mergers in pattern of consolidation. Also, others indicate that though in the short run we could see problems, however, in the long run, because of the lag length of the system, it could still come out to be okay. Yes, I will speed up. Also, a relationship between concentration and banking crisis was well captured in the literature. market power versus risks. Market power hedge for risk and bank behavior also was well discussed. So for Nigeria, context analysis, what we try to do is to look at interest rate management within the country. As Balogun's captured, the four phases were 1996 to 1992, openness of the market, 1993 to 1998, reintroduction of regulations, and 1999-2004, trying to stabilize the system based on what it was perceived from the fragmentation reported earlier. Now, evidence of financial intermediation indicates absence of changes in the banking internal characteristics and clear evidence of ill health. This was manifest, and this is why we need to study and see whether there was truly and typically some gains. Now, to ensure stability of the system, that's why, like I said earlier on, the capital was boosted from barely 2 billion to about 25 billion per bank. Now, so unlike, the market determined models in developed markets, what happened in Nigeria is by fiat. So it is possible therefore the productivity measures could change. Now, our methodology is taking a position that increased asset base should increase lending, which should drive interest low. And we are using the DEA and MPI technique to measure the productivity in the system. The DEA scores will be used, that will be generated from the panel data, will be used to raise the productivity indices. We will not bother with due to short of time, the mathematical analysis of the functional relationships and how the model is built. But we are aware we use distance function in establishing the MPI. Now, MPI can be decomposed, and it's critical for us in this work. We want to see the catch-up and the boundary shift components. Now, the variables that we chose to specify the input and output from our approach of intermediation. For output, we pick performing loans and other investments, and for the inputs, we chose deposits and operating expenses. Population will be the entire banks at that time, 24, out of which we chose 17 based on criteria of age, consolidation style, and natural efficiency strata, which segmented them: new generation, old generation, and the way they consolidated, capital boosting, merger or acquisition, efficiency strata, foreign, local, the same, and it is distributed like this. Now, graphically, this is the way they stand per class, per the four classes that we are considering. And our results and discussions, the DES efficiency scores, table 1 and 2 will give the rundown of the basic performance indicators at the time of compliance of the consolidation. From constant return to scale measure, you can see that new generation bank seems to be declining when we look at the capital boosting group, while the others, like the old generation and the mergers, indicate improvement. Even the new generation bank for acquisition, they also have indicated improvement. However, the most fitting is the variable return to scale measure, whereby you can see the capital boosting is static at full efficiency, 100%, because they are the target, naturally, because they are the strong part who did not need to merge or acquire, but just pure capital boosting, and they are able to remain at the efficiency level. Others have moved over time, some reaching full efficiency, some of the new generation banks, and the old generation bank hitting 94%, which, as expected, a very good result. Now, the productivity, once the index is more than 1, we see growth. If it's less than 1, it is a decay. If it's equal to 1, it means there are no changes. Now, we also calculated the two based on constant return to scale and variable return to scale using input orientation. And the results are contained on table 3 and 4. Now, when you look at the constant return to scale, the result indicates improvement at other three levels, like the last two tables that we've seen. Again, consistently, the new generation banks with capital boosting staying at the benchmark, even though they should have indicated some improvement, growth. You can see growth in other lines. Of course, they remain static without growth, but it's not a bad result in the fact that they technically are not benefiting from the general capital boosting. It remains so even with the variable return to scale, which is the more adequate in measuring the situation in Nigeria. So we can see from 2005 to 2009 different levels of the measures, what the result is. Now, conclusion, a recommendation. In conclusion, there is evidence that the consolidation exercise as structured was timely in expanding the liberalization gains. Also, the system as a whole and on category basis indicate that both efficiency and productivity have been recorded. Again, though the process was driven by fiat, banking system being the core, it shows the basis for other consolidation drives should be initiated within the financial system. By recommendation, from gains of the consolidation exercise, it is recommended that the exercise should be deepened to encompass other sectors of the financial system. Cultural change need to be influenced. As you have seen, it has helped, especially the old generation banks. Lastly,